Dave Schurman is back for our 14th season of Finance Friday, and we're starting off with a hot topic, Dave, the process of blind bidding in the housing market. Nice to see you again.
Yes, good to see you again as well, Annette, and Bob back there. Hope you guys had a great summer. Yeah, blind bidding has been a thing for the last few years, and it really has not been good for the real estate market. I mean, what happens is an agent lists a home for a seller, and then rather than negotiate one-on-one with somebody that puts an offer in, they accept these bids, and bidders are basically blind in the fact that they don't know who they're bidding against, how many, or the amounts that that the other bidders are bidding. So in a lot of cases, what will happen is the house will go over list price quite often now, as well as the bidder that ends up winning the bid. I guess if you could say winning, but in most cases they're paying a lot more than they should. So as an example, if the next best bid is $500,000 on a property that's listed at $480, somebody might come in at $550, not knowing that 501 or 502 could take the place. So it really hasn't been good for the industry at all.
And it's become an election issue.
Yeah, I mean, the Liberals, Trudeau has announced that he would outlaw blind bidding if he's elected again. Each of the parties have their own policies on real estate and how they're going to address the escalating home values. But it really is. Most economists, even a lot of real estate agents, admit that blind bidding is not a good thing. There's been a lot of complaints to the regulators about blind bidding. Another tactic that some of the agents will use is they'll list a place below value, and that'll attract a lot of interest. And then, people think they're getting a really good deal, so they'll bid a little bit over. And then the agent, although they're not supposed to, some of the agents will say, we have received bids above this amount, so unless you're going to come in at a certain price level, good luck. And then people get frustrated. So it's, again, it's just not good, and hopefully whichever party wins the election will outlaw it.
Right. There's also been a very big increase in the amount of home equity lines of credit. Instead of people using mortgages, they're using a line of credit.
Yeah, and there's a few reasons for that. Obviously, low rates, low interest rates. A home equity line of credit, a HELOC as we call them, they're tied to a variable rate in most cases. So it's the low rate of today, and many people pay interest only. COVID has really caused HELOCs to increase a lot as well. In fact, HELOCs are about 50% more this year than they were last year. So it's an unprecedented level of people taking out equity in their homes. Because of the value increased as well in people's homes, there is equity available. People are building decks and swimming pools and renovating their basements. And a lot of times it's easier to use a home equity line of credit because it can be a second mortgage to your first mortgage. It's easier, it's quicker, and again, people pay interest only on it, which is dangerous. Yeah. But it makes it a little more affordable for them in the short term, at least.
Now, what happens if the housing market crashes and you have a home equity loan for an amount of what your house was worth? What can happen then?
Well, it certainly is not a good thing if you owe more on your house than it's worth, and that can happen, whether it's a first mortgage or a home equity line of credit or a combination of both. But a tip for homeowners out there. A lot of people will consolidate debts as well, pay off higher price debts and put it on a home equity line of credit. Again, not a bad thing, but a tip for you out there, if you're paying interest only, then you're really not paying that loan down. So even though you're consolidating debts, you're paying them off. If you're paying interest only on your line of credit, you're really not paying that debt off.
Right,
and then once interest rates start going up, your payments are going to go up.
Yep.
So you're better off to consider that line of credit, even though you don't have to pay more than interest. Consider that line of credit a term loan and start paying some balance off on it too. So at least you'll start seeing that balance going down every month, which is what you should be doing.
Good advice as always, and nice to see you back, Dave. And if you have a financial question or topic you want covered by Dave, email your questions to financefriday@firstontario.com or get in touch through Twitter at finance_Friday. And if your question or topic is covered on air, you'll get a gift card from a local business in your community.